listening to the Agent Survival Guide podcast, a podcast for today's insurance agents. Informing, educating, empowering, improving the way you do business in an industry that's anything but static.
In today's episode, we break down how the 2026 ACA final rule affects you and your clients. CMS finalizes improvement to marketplace plan selection with 2026 final rule written by Emily Ryan. The Department of Health and Human Services, HHS, finalized the 2026 final rule for Affordable Care Act coverage on January 13th, 2025. This final rule puts into action the protections previously proposed in the 2026 proposed marketplace rule with a few slight modifications. The Centers for Medicare and Medicaid Services, CMS, aims to increase protections for individuals enrolling in marketplace plans, accessibility to affordable health care options, and their authority to suspend agents who make changes to their enrollees' coverage without their permission. As of the organization's last update, 24 million individuals have selected an Affordable Care Act, ACA, insurance plan during the 2025 open enrollment period. Let's evaluate the final rules that could possibly affect how agents, consumers, and carriers interact with the marketplace. We'll start with the more rigorous agent reviews that are coming and penalties for unauthorized actions. CMS will now be able to use their expanded authority to immediately suspend an agent or broker's account if they, quote, pose an unacceptable risk to the accuracy of marketplace eligibility determinations, operations, applicants, or enrollees, end quote. The new penalties will reduce the number of complaints of unauthorized activity in the marketplace. Updating this policy advises agents to maintain compliance or be terminated immediately. The next one we'll go over is the standardized actuarial values for qualified health plans. To improve plan quality and choice, CMS is standardizing actuarial values for all plans that meet the qualified plan requirements. This will guarantee that qualified health plans in one area are equitable to the plans offered in another area. This ensures that individuals in urban areas and rural areas have the same access to quality and affordable ACA coverage. Carriers that offer marketplace plans on the federal marketplace are required to offer qualified health plans in every product network type, at every metal tier, and throughout every service area where they offer non-standardized coverage. Additionally, the 2026 final rule requires that standardized plans have actuarial values aligned with the plan's metal levels to maintain consistency in plan designs between carriers. Carriers that offer multiple standardized plans within the same product network type, metal tier, and service area must differentiate the plans between one another to limit duplicate plans. Educate yourself on your client's plan benefits, network, and drug coverage to better inform them of their own plan benefits. We also encourage you to become familiar with popular marketplace plans in your area to help your client select the right plan for them. Moving on to the updated consumer authorization and consent form. A revised model consent form CMS document intended for agents to use while collecting client authorization and eligibility applications was finalized with the 2026 final rule. The most updated version meets the standard requirements that were outlined in 2024, but serves as a guide for agents. There is also a template agents can use while making a phone call to collect the required information before processing an application. We have a consumer authorization form and a consumer eligibility attestation script and accompanying form. You can find the link to download these scripts for free in the episode notes. The next one is allowable cost sharing reduction loading. Previously, CMS proposed cost-sharing reduction loading practices are allowed when the adjustments are reasonable, justified, and follow state law. CMS finalized the cost-sharing reduction as, quote, "Loading is allowed when the adjustments are actuarially justified and follow state law, provided the plan issuer does not receive reimbursements for such amounts," end quote. Cost-sharing reduction loading refers to when carriers increase premiums to offset the costs associated with offering health insurance tax credits. Enrollees use premium tax credits to minimize the amount they pay for deductibles, co-payments, and co-insurance. Cost-sharing loading can inflate the costs of a health plan, but the increased costs don't always reflect an increase in value of benefits. Next, updating payment threshold to minimize coverage gaps. Historically, clients with lower incomes may have been placed into a grace period when they fail to pay their monthly premium, forcing them to make a full premium payment by the end of the month. These grace periods often result in termination, causing individuals to lose health coverage for carrying a balance. CMS is giving carriers the ability to set one of 3 thresholds to reduce coverage gaps for marketplace clients. These protections empower clients that may be experiencing financial hardship. 3 payment caps have been finalized by CMS. The first is a fixed dollar threshold. It is permanent fixed. Carriers set the threshold at $10 or less. What that means for clients is those who pay their first premium payment and then owe $10 or less after their tax credit would not be placed into a grace period. The second option is the net premium threshold. It is a premium percent option. Carriers set their net premium percentage threshold at 95% or higher. Clients who pay at least 95% or whatever threshold the insurer decides of their premium after the tax credit would not be placed into a grace period. The last one is gross premium threshold. This is another premium percent option. Carriers set their gross premium threshold at 98% or higher. Clients who pay at least 98% or whatever threshold the insurer decides of their total premium amount due would not be placed into a grace period. The last finalized parameter we'll cover today is ACA subsidy clients granted 2 years to file. Individuals who receive subsidies and fail to reconcile their tax credits for 2 consecutive years must be notified that they could lose their premium tax credits. CMS now requires that the proper exchange must make individuals aware of their standing and provide the opportunity for them to reconcile their subsidies. Ensure that your clients are aware that they must reconcile their premium tax credits when filing their federal taxes. The changes and client protections CMS finalized for the 2026 plan year have a clear goal: enhance consumer protections while ensuring access to quality and affordable coverage. It's important to become familiar with this final rule and educate yourself on the marketplace plans available in your area. For recommendations of products and plans to add to your portfolio, you can view Ritter Insurance Marketing's ACA plan offerings or contact our sales team to arrange a time to discuss carriers that would be beneficial for your business. If you're not already a Ritter agent, now is the time to become one. You'll gain access to our knowledgeable team and our suite of online tools. We'll have the link to get started in the episode notes. Thank you so much for listening. We will see you next episode. The Agent Survival Guide podcast is a production of Ritter Insurance Marketing, an integrity company. This episode was written by Emily Ryan, recording and production by me, Tina Lamoureux, script proofing by Sarah Ruppel, podcast design by Urban Rivera, artwork by Vivian Zhao. Rate and review our show on Apple or Spotify.